Hi, this is Brandon Bischoff. I'm Vice President of Portfolio Strategy at Canterbury Investment Management. Today is Monday, March the 23rd, 2020.
And this is Tom Harden, Chief Investment Officer of Canterbury Investment Management. And today, Brandon and I have some important things to discuss.
We want to start by saying that this is a very scary time for all of us. There's a large amount of anxiety that comes from not knowing how this coronavirus is going to play itself out. Our daily lives and our normal mindset look much different today than they did just a couple of weeks ago. But that being said, this too will pass, and hopefully we will get back to normal sooner rather than later. It's times like these when we have an opportunity. We have an opportunity to focus on the truly important things in life, which are your faith, your family, and your community. In the meantime, we have a well laid out plan to deal with the impact that the volatile financial markets are having on our portfolios. With all the noise surrounding us, we want to take a step back and try not to focus on or worry about the pandemonium that's being created by various market pundits and the news media.
As Brandon said, this is a very emotional time. Our thoughts and prayers go out to all of those who've been affected by this virus, as well as friends and family. No one alive today had ever experienced a wide business shutdown or such a rapid shift in the market's behavior. Over the past 20-plus trading days, the liquid financial markets, including stocks, bonds, commodities, have shifted from complacency to outright irrational volatility. Brandon and I are going to discuss each of the three market environments that we just experienced. Most important, we'll discuss what actions need to be taken to come out of this nerve-wracking period with our funds intact, or even potentially benefit from the volatility as the markets return to normal. We'll start by showing some charts as well as discuss the psychology of what the various markets looked like when the S&P 500 reached its peak. Next, we'll show the market correction that followed, which is defined as about an 8 to 12% decline from the peak. Then finally, the recent market anomaly that's being driven by the madness of crowds. It's the actions of the crowd of irrational investors, all moving together at the same time and in the same direction, that's the cause for the recent wild swings in the markets. We'll start by looking at a chart of the S&P 500 after it reached its new all-time high on February the 19th. Brandon and I just completed a series of charts that'll take about 7 minutes or so after I get finished. I thought I'd do this quick summary for those of you who don't want to go through the charts. Believe it or not, the peak in the S&P 500 occurred 22 days ago on February the 19th. So long 22 days. We entered a corrective phase starting on February the 24th, and that lasted for 10 days, was about a 12.2% decline from the peak, and it ended on March the 6th, which was a Friday. Now, March the 9th is when everything changed. We then at that point began a period where we have trading anomalies day after day, days that statistically shouldn't even exist. March the 9th saw the S&P 500 decline 7.8%. Now, Brandon tells me that that is a 7th standard deviation day, and what that should occur about once every billion plus years. And we've had 3 other days that are even bigger than that over the last 11. We had a 9.5, a 9.2, and a 12%. Astronomical days. Now, these 11 days have seen the S&P 500 drop an additional 22% to be down 34%. The Russell 2000 is down 40%, and the mid-cap S&P mid-cap is down 40%. Actually, Treasury bonds, which you think would skyrocket in this kind of an environment, had a peak to trough decline of 16%. It's a little bit higher now. So the point of this is that this is really an unprecedented event. pricing at this point, percentages really don't matter once you're in an irrational environment. Bottom line, this is not your run-of-the-mill bear market. According to a study done by Charles Schwab, a typical bear market lasts for about a year and a half and sees a decline on average of about 39%.
Currently, the market's sitting 34% off of its high, which was again on February the 19th. That's 22 trading days ago. And in fact, 22% of that 34% decline has occurred in the last 11 trading days.
Yeah, so we've had days that are up, that are down 7, 8, 9%. When you have this kind of a decline, it's kind of like...
It's like the stretching of a rubber band.
Yeah.
So the further you stretch that rubber band and kind of the faster you stretch it, the more likely you are to see some of those snapback rallies.
Yeah, and as soon as we get some good news, you'll see an event that's going to be very similar to that. As a matter of fact, between 3 o'clock this morning and 8 o'clock, which is 5 hours, we saw the S&P 500 go up, the futures go up 10%. Now, to have 2 or 3, 4 days like that back-to-back to regain about half or so of this rally is a very high probability.
It would not, yeah, it wouldn't
expected
be
to happen.
unlikely, especially in this kind of environment where we are used to seeing those kind of wide trading days.
Right. So the biggest mistake I think that investors can make right now is to put yourself in a position of having more exposure on the way down during this anomaly and then less exposure on the way back. I know this is really a very scary and emotional period, and the tendency is to pull back enough to where you can sleep at night. I've heard that analogy a lot of times. Well, that's not the advice you want to take here. We're set right now, the portfolio is set to be able to deal with this kind of an environment. We have a strategy put together that will capture most of this advance, the snapback advance when it happens, and then we'll stabilize the portfolio after that. So I hope this video was helpful. Again, I would encourage you to listen to the
Charts that follow this, yeah.
Yes, and thanks for listening, and we'll talk soon.